I'm Jarrad Brown, Australian expat financial planner based here in Singapore, and welcome to my video series where we tackle some of the tough personal finance questions for Australians all over the world. Today I'd like to share with you some top tips when it comes to property deductions for our investment property back home. I thought this would be particularly relevant as we head into the end of the Australian financial year to give you some insight, tips, ideas for things you might want to think about to pay less tax in Australia. After all, a common reason for many of us for why we actually left Australia in the first place. So let's dive right in. Now, it will come as a surprise to nobody, particularly Australian expats, that Australians have a love affair with property. Bricks and mortar, we can touch it, we can feel it, we can go back and live in it if we need to. For whatever reason it may be, we just tend to veer towards property. Property has performed very well over the years, and obviously the tax environment in Australia can make it a desirable investment strategy for when it comes to actually creating future wealth. Now, if we look at the actual size of the property market in Australia, particularly the residential property market, it's about 2 to 3 times the size of Australia's superannuation system. Now, Australia's super is no small beast at all. It is one of the largest and most proficient retirement schemes or pension schemes in the world, and it's valued at around the $3 trillion mark. So that gives you an idea of just how large Australian residential property is. Now, there have been many talks and discussions and news headlines over the years that Australian property would lose the negative gearing benefits, and it may very well happen in future years that there are tweaks, there are changes when it comes to tax deductions that we're eligible for those of us that own property back in Australia. But as the rules are what they currently are, we can claim deductions, so I'd like to share with you some of my tips for things to think about when it comes to reducing your tax in Australia. So let's get into it. Now, the first and most simple deduction that we have when it comes to reducing our taxable income in Australia is the interest that we pay on our mortgage. Now, be very mindful that this is only interest on a mortgage that is secured by or used to generate rental income, i.e. a mortgage that we have on our investment property. If we have a mortgage and our family are living in it, or we're not renting out that property, then that interest is generally not tax deductible. Now again, any matters of tax, be sure to reach out and seek professional advice. I'm not a registered Australian accountant, so make sure that you reach out to your financial planner or to your Australian accountant and make sure that you are making the right claims when it comes to your own tax deductions. But interest is certainly a common one. You may also want to think about prepaying your interest on your loan, because that can also allow you to bring forward a tax deduction into this financial year from the next one. Now, that is obviously going to have future ramifications for the years to come. So again, make sure that you receive advice and you are actually claiming those deductions in the right years. My second tip when it comes to deductions is the depreciation of the building costs. Now, by building costs, I mean the cost that was outlaid to actually build your investment property. Now, even if you haven't built it, if your property isn't too old, there may still be depreciation benefits that you're entitled to. Under the Australian rules, depreciation of building costs can typically be claimed at 2.5% over a period of 40 years. Now, for those of you that can work out the numbers there, 2.5 multiplied by 40, that's the 100% of the building costs that we can deduct over time. So if you do have a property that's not older than 40 years, you may want to think about getting what they call a quantity surveyor's report or a depreciation report, which outlines exactly how much of the building costs you can claim each financial year. The third tip is the depreciation of the fixtures and fittings. So light sockets, power sockets, whatever it may be, not the actual building costs, but the fixtures and fittings when it comes to your property. Now, these have a much shorter depreciable life than the building costs, but again, within a quantity surveyor's report, they will be able to outline for you exactly what you can depreciate. The newer your property, the more fixtures and fittings you'll be able to depreciate in terms of the costs that were involved, and reduce your taxable income that way. Now, this is not a recommendation that new property is better than old property. It's quite simply that it often carries greater tax benefits. So again, make sure that you receive professional advice here, reach out to a property advisor and a financial planner, and make sure that you're making the right decisions based on your own circumstances. The fourth item you may want to think about claiming is all of the rental costs. So if you have a property manager in place, this is going to be your property management fees, your council rates, water rates, maintenance, repairs, mowing the lawn, repainting, whatever it may be, all of those costs that are involved just to actually rent out your property. They are all deductible because you're utilising or you're actually outlaying those costs to generate a rental income. Now, your property manager should be able to provide you with an annual report which outlines all of the rental income you've received and all of the costs that have been outlaid for you. So that'll give you a very simple, nice, neat and tidy number that you can plug in to your tax return. My fifth tip when it comes to tax deductions is any financing costs. Now here I'm not talking about the interest on your loan, but any fees that were associated. Did you pay a mortgage broker or an advisor to give you advice on the actual loan structure and strategy? When it comes to financing your property, you may find that those costs are also tax deductible. So again, reach out to your accountant, make sure that you're not missing out on any deductions that you're eligible for. And my sixth and final tip when it comes to your tax deductions on your property is any accounting costs. If you're paying your accountant, your financial planner, to give you advice on generating income, particularly in the form of rental income, you may find that some or all of those costs actually be eligible for a tax deduction. So again, seek professional advice, reach out to your accountant, ask the question, and make sure that you're not paying any more tax than you need to be. I hope you found these 6 tips helpful. I hope it's shed a little bit of light, something you may have not already been aware of that you can claim. If you have any questions at all, please do feel free to reach out. If you have any tips for our future videos, let me know. I'd love to hear from you. Thank you very much for tuning in. I look forward to seeing you next time. Thank you.